Good morning, everyone, and thank you for joining us for the first part of our three-part CUSO education series. A couple of housekeeping notes. For those of you that are in attendance, please keep your mic muted, and we will have time towards the end for questions. And then you may also utilize the chat. And so if you've got questions throughout, if you want to put those in the chat, I can make sure that our speaker sees that information. For those of you who don't know me, my name is Chris Whalen. I'm the Vice President of Marketing and Strategic Solutions for Connecticut's Credit Unions and QVoyant. Real quick, Connecticut's Credit Unions is the united voice and resource hub for credit unions across the state. We work alongside the credit unions throughout Connecticut to strengthen their ability to serve people, businesses, and communities with integrity, innovation, and care. And QVoyant is our solutions arm of Connecticut's credit unions, but we work with credit unions nationwide, helping credit unions see clearly and achieve what matters. We have a particular focus on medium and small size credit unions. QVoyant has a full suite of compliance solutions, consulting services, and operational support services. I'm thrilled to have our friends at the National Association of Credit Union Service Organizations, or NACUSO for short, here with us this morning. NACUSO is the leader of innovation, collaboration, and advocacy for CUSOs in the nation. And we do have their president and CEO of NACUSO here with us, Randy Salzer. Thank you, Randy. I hope I said your last name right. Thank you, Randy, for your leadership in development of this series with us. And if for those of you in the room with us are not quite sure, I'm talking about NACUSO and National Association of CUSOs. If you're not sure what CUSOs are yet, well, that's awesome because that's why we're here today, and that's what today's all about. So today is part one of a three-part series that will cover what CUSOs are, how to partner with them, and how to invest with them. This morning, we'll focus on the foundations and fundamentals of CUSOs, what they are, why they exist, and we'll explore some common CUSO structures and go over real-world examples of successful CUSOs. Our expert speaker today is Brian Lauer, General Counsel for Messick, Lauer, and Smith, PC. Um, Brian literally wrote the book on CUSOs, so we've got it here. So if you're interested in that, you can grab that. But Brian literally wrote the book, so we've got a tremendous expert with us today. Brian concentrates his practice on assisting credit unions primarily through CUSOs in finding effective ways to work collaboratively with other credit unions and third-party service providers. Welcome, Brian. Thanks so much for joining us this morning, and I'll hand things over to you.
Thanks, Chris. I really appreciate it. I am with Messick, Lauer, and Smith, but I'm also General Counsel for NACUSO too. So, providing this on behalf of NACUSO is really important to me and our practice. So today I'm going to share my screen first. Let's get that going. Okay, can everybody see the screen? All right, perfect. And just to reiterate what Chris had said, I'm not going to really have the ability to see the chat. So if you have questions, please put those in there along the way. And Chris is going to just flag for me or stop me. I don't have a problem stopping in the middle, but I will have some time at the end for questions as well. So today, as Chris said, we're going to be talking about the importance of CUSOs, the fundamentals, the reason why CUSOs are important to the industry. So let's just kick right into that. So the way I think
Hey,
about
Brian.
CUSOs,
Hey,
oh,
Chris,
yep.
can you see the
Yeah,
slides?
yeah, I'm not
The
seeing the
slides on there.
slides.
Yeah,
I was just changing my views and making sure I didn't have
Huh.
that wrong.
me too.
There
Got
we
it
go.
now.
Now
There you
Oh,
go.
then.
sorry about that.
Oh,
All right. We're all good now?
Yes.
Okay.
yeah.
Sorry about that, everybody. Um, so when we think about CUSOs and why they're important, we are really thinking about what ways in which we can create income diversity, member and asset growth, and credit union relevancy to their members and within the financial services industry. So when we talk about income diversity, you can invest in CUSOs or form CUSOs to create non-interest income, to generate interest income that you may not have otherwise been able to have access to. In addition, you can think about member growth and asset growth. So you're using CUSOs to be able to generate or attract new members, whether that's through technological innovation or or developing a new loan type of some sort. So you're creating that member and asset growth, and you also are able to remain relevant to your members. So as we move into a more digital and mobile environment, financial technology is really important, and CUSOs are a really good way for you to implement, develop, partner with that technology in order to continue to stay relevant to your members. So before we get into a little more detail, I thought I would just provide some industry statistics for everybody. So looking at this slide here, you can see that credit unions that credit unions investment, excuse me, in CUSOs has really increased over the years. If you look at this going back to now our data, I will say with these industry statistics, the data is a little bit difficult to get to at times. So some of these slides will be slightly older data. But over that decade from 2013 to 2023, you can see that the credit union investment in CUSOs has incredibly increased, and the percentage of credit unions actually participating in CUSOs has increased quite a bit. In addition, you can see that the growth for credit unions has increased as well with those that are participating in CUSOs, and the total investments in CUSOs by asset class, or percentage of credit unions participating by asset class. Obviously, there's more in the 1 billion and up, but we'd love to see more of the lower or the smaller credit unions being involved in CUSOs, and we'll get into that as we move along here.
Hey,
Quickly
Brian,
looking at
we did a quick question. Someone mentioned they heard that the NCUA is saying that they would rather have a credit union form a separate company rather than a CUSO. Are you aware of any of that?
So that's a great question. So in fact, a CUSO, and we'll get into this in a little bit more detail, but a CUSO is in fact a separate entity. So you aren't providing CUSO-like services at the credit union. You're in fact forming or investing in a separate entity that is in fact the CUSO. So that is a requirement of the CUSO regulations or the credit union regulations as they relate to CUSOs. So looking at this, you can see those credit unions that are participating in CUSOs are growing faster than those that aren't. You can see here that they're also, or I should say that was in asset growth. This is in loan growth. It's about the same. I do think that this constriction was part of the liquidity crisis, but in general, over the last decade or so, you can see that there's more loan growth with credit unions investing in CUSOs or using CUSOs. And then operating expense. We would love to see this come down a little bit. Those participating, we would hope, had operating expenses that were a little bit lower than those that aren't. One of the things we're thinking is that if smaller credit unions are using the collaborative model and the collaborative approach to products and services, back office and the like, you would be able to bring that operating expense ratio down by participating with CUSOs. And you can see that typically over the years, now it has constricted a little bit, but typically the return on assets has been higher. Again, I think this 22-23 time period is more around the liquidity crisis that the credit union industry was going through. There was some constriction in that at that time period. But overall, if you see over the years, the return on assets has been better for credit unions that are invested in CUSOs So again, all of these industry statistics are meant to show you the advantages of credit unions, how much better credit unions are doing that are investing in CUSOs, and how CUSO investment can actually improve the credit union's balance sheet over time. Now, why CUSOs? Let's get back to this concept. I break this down into four different categories. I've touched on it a little bit already as we've been talking, but one of those categories is income. And so when we think about credit union income, the traditional credit union model has become increasingly difficult over the last 15, 20 years. It's hard to come to for a credit union to only be able to rely on yield from taking in deposits, making loans at a higher interest rate. That yield is being squeezed. Competition is squeezing that. And then in addition, your operating expenses are squeezing against that yield as well because you have increased compliance costs, increased IT costs, and the like. And so, really, credit unions should be looking for ways to generate non-interest income or other types of income that they wouldn't otherwise be able to get. And so when we talk about non-interest income, a perfect example of this is credit unions that are using something like a property and casualty insurance CUSO. This is an ability for a credit union to be part of their members' financial lives in an area where the credit union wouldn't traditionally be by helping them to get their home or auto insurance or something similar. The beauty of that is the credit union gets to own the relationship with their member as they move into, or as they look to buy property and casualty insurance or the like. But also the credit union through the CUSO gets to share in the premium being generated by that insurance sale. This is something that if you have a referral relationship, maybe you're getting a little bit of referral income with a third party insurance agency. But in this instance, you're able to get additional access to that premium income by offering that product through or insurance products through a CUSO. So again, that's just a simple example of using a CUSO to generate non-interest income. Another non-interest income opportunity would be if you're investing in a technology product of some sort, and that product is either generating revenue, which it would result in dividends, or down the road that product or service or that company is sold, and you're able to take part in the liquidity event of that company, which is non-interest income to the credit union. So those are examples of using non-interest income or using CUSOs, excuse me, to generate non-interest income. Now, I also said interest income, and a lot of people will think, well, why would we need CUSOs to help generate non or interest income when that's what credit unions do? We make loans at the credit union and we generate that interest income. But CUSOs are a great opportunity in a couple of ways for credit unions to get access to interest income that they wouldn't otherwise get. One example is just a product or service that the credit union doesn't have the bandwidth or the expertise to provide themselves in-house. A good example of this over the years was business lending. Credit unions often wouldn't have the in-house expertise to have their own business lending department. But if they collaborate together with other credit unions, they're able to form almost like a third-party business department that is serving several credit unions rather than just one. And so you get access to that expertise that you need. And you'll see that's one of my categories here too, but you'll get access to that expertise to make business loans, but you'll also get access to the interest income from making or taking part in that business lending operation, so that, again, generating some interest income that the credit union wouldn't otherwise get. Another example of interest income and getting interest income that the credit union is otherwise not able to get. I like to use the example of indirect lending and Cuddle, or now it's known as Origence. Origence is a CUSO, as many of you know, and it's really kind of a cool story. The idea was that back when Origence was being formed, or CU Direct was being formed, the credit union saw a problem that their members were no longer coming to the branch to get approved for an auto loan and then going and buying a car based on that approval. That was sort of the old way. But your dealers were disrupting that because they don't want a buyer to come into the dealership and leave without buying a car. That's their goal, right? To sell the car. And in a way, your credit union members aren't in the business of shopping for a loan. They're in the business, or they're in the market to buy a car, not a loan. And so what happened was the dealers started financing those loans in-house, and credit unions started losing those loans. So Cuddle was a collaborative effort in order for credit unions to get into the dealerships in order to capture their members' loans that would otherwise be going to other lenders in that buying experience. So again, using CUSOs and collaboration in order to get interest income back on the credit union's balance sheet that would otherwise be potentially walking out the door. So to reiterate, income is obviously a very, very important part of why CUSOs are important, and you can get non-interest income and interest income by using CUSOs and collaborating, as we just discussed. Innovation is another category of why I think CUSOs are important. When we talk about innovation, we're thinking about financial technology solutions, having a seat at the table, being part of the decision-making process when you're talking about your delivery channels, and using CUSOs to make sure that credit unions are a part of that process. And we've seen this a lot over the last 5 to 10 years, where credit unions are using the CUSO powers to be able to invest in financial technology and have that seat at the table, have that strategic insight into where their delivery channels are going, and making sure that the innovative technology is not moving away from what is important to the credit union industry and why that technology is important to the credit union industry. Too often we had seen, previously, that credit unions would be very, very important to beta testing and helping to model out a financial technology product, but never have a seat at the table, such that when that company got up and running and started generating more income from non-credit union clients, they started to look away from the credit union industry, not be as focused on the credit union industry. And so we see the CUSO model as an ability for credit unions to have a seat at that table, to be a part of their delivery channels, and create that innovation and technology that's important to their credit union members and the credit union business. Expertise, I touched on this a little bit, but you can use the collaborative model in order to get expertise that you would not otherwise have. And there's another way of looking at this too. When you collaborate, like let's use my business lending example I used before. When, say, 10 credit unions collaborate to spin up a business lending department, if you will, for all 10 of those credit unions, they are that one department, they get access to something that they might not have the capital to do in-house, but they also are getting presumably better quality expertise within the business lending CUSO, because they are not spinning up 10 different business lending departments, hiring 10 different business lending people to do the same job at those 10 credit unions. You're getting the best of breed expertise and quality within that CUSO collaboration to serve all 10 of those credit unions. So again, you can use the CUSO collaborative model in order to generate or to get access to better expertise. And then finally, savings. We think about savings in the context of, I've mentioned it a little bit already, but if you're doing back office support through a collaborative model, you're able to generate savings within your credit union. The business lending example I just gave is part of that. Let's, again, the example, 10 credit unions each put in $100,000 or $200,000 into a collaborative model to be able to put that $1 or $2 million of capital to work to build that department. If they had done that each on their own, they would have probably had to invest $1 million of their own capital in order to get that department up and running. Again, setting aside the fact that the expertise may not be as high as what you would get if you collaborate. But in addition to that, you're spending a whole lot more, 10 times in my hypothetical, more than you would if you collaborate. So you can get that savings. If you think about any type of back office kind of process at a credit union, all of those processes are being conducted, or for the most part, those processes are being conducted at every credit union you can think of. So why not collaborate and do those things together, and you get the efficiency of not having to each have your own back office expense. Um, Another example of this would be IT, and we saw this about 10 years ago become pretty prevalent. There were OTS or Open Technology Solutions is one of the primary examples of this, but three credit unions got together. They formed a CUSO to be the IT department for each of those credit unions. The credit unions were then able to get better expertise, presumably within that one IT department. But they were also able to reduce their operating expenses because they were not having to each run an individual IT department. But the other piece of savings here that's important to mention is that you also get economies of scale in using that collaborative model. So the OTS example, they were able to then go collectively as one entity to negotiate with their third party delivery channels, whether that be their core processing company or their mobile or digital companies. And in turn, they get scale by going as one entity representing all three rather than each trying to do that on their own. And the OTS folks, when they did in fact go and try and go to negotiate for a core processor, they did that collectively as one entity, and they estimated that they saved over $1 million a year in expense by getting those economies of scale. So another way of thinking about savings. I'll just pause there. I've been talking quite a bit into the ether. Are there any questions?
None right now.
Okay. So this slide, I'll bring it up quickly. It's just what I just talked about. I just kind of like to have the picture up there. I'm happy to share these slides afterward, just for your reference. But now I just want to talk about the regulatory landscape for CUSOs. We touched on a bit of this already, but I break the regulations down into three different pillars here. Primarily serves. So a CUSO its customer base must be 50% or more credit unions or credit union members, depending on the business type. So if you have a B2B type business, like your business lending CUSO as an example, more than 50% of the client base needs to be credit unions in that instance. Now, that is not the variable that is used in order to define whether a CUSO is primarily serving is not defined in the regulations. All we know is that primarily means more than 50%. That's all that's been described to us in the regulations. So you would need to look at several different variables. The most common would be number of clients, right? So in a business lending example, again, just to follow that thread through, if you had 10 clients and 9 were credit union clients, then 90% of your clients are credit unions. You'd be primarily serving credit unions. But you also want to think about maybe revenue as well. So if I told you that 10 clients, 9 are credit unions, but the 10th client was a large regional bank, it may be that 10th client, that bank, is generating 80 to 90% of the revenue for that CUSO. So that may show that the CUSO is not primarily serving. It's really more focused on that one client rather than the other 9. So you do want to look at a variety of variables in order to make sure you're not out of whack, as it were, in my example, that within any one of them. The other thing I like to say here is that a CUSO and a credit union investor in that CUSO should have a narrative around why they're primarily serving credit unions. So maybe it's in that my example, yes, 90% of the credit union or 90% of the clients are credit unions, 90% of the revenue is this one bank, but maybe the narrative is something along the lines of, well, we're using that one bank to subsidize the services that we're able to provide to our 9 credit unions, and we're focused on the credit union industry. Just so happens we have one client that's not a credit union. So you kind of build that narrative that shows you are focused on the credit union space, and you can show that and you can see that by looking at that number of clients variable. The other pillar here is permissible services. So these are outlined in part 712.5. There it's a categorical list in 712.5. In general, if a CUSO is performing a service that is part of the routine operations of a credit union or part of the routine financial services that you would provide to a credit union member, it is a permissible service. That is the general rule. But you do want to make sure that your CUSOs are performing permissible services. So an example of this that I like to give is you could have a CUSO that is assisting with auto lending, and that is a permissible service. It's part of the routine operations of credit unions. It's part of the routine financial services that would be provided to credit union members. But you could not have a CUSO that is an auto dealership because that is not a financial service. That is the retail service of selling cars. But then to provide a little nuance here, a CUSO could be part of the repossession process of the loan process, right? So you could have a CUSO that assists a credit union in repossessing cars and then selling those cars. That might even require that there be a dealership license at the state level because the state sees that as selling cars. But the NCUA and the credit union regulators would see that as just part of the loan process of repossessing cars and selling them. So again, just a little bit of a nuanced thread through what permissible services means, but you do need to keep focused on the fact that your CUSO has to provide services that are part of the routine operation of credit unions or the routine financial services that you're providing your members or are provided to your members. And then finally, there's some technical requirements. You have to have minimum of quarterly financial statements, audit. You have to have an annual independent financial audit of a CUSO, unless that CUSO is wholly owned by one credit union. Then in that case, you can just rely on the credit union's audit. You need to keep your books and records in accordance with GAAP. You have to get an attorney opinion letter that states that the credit union's investment in the CUSO is the sole liability that credit union has for the operations of the CUSO. That's what's typically known as the corporate veil. And then you need to have an agreement with the CUSO where it contractually agrees to have the NCUA have access to that CUSO's books and records. And then finally, you need to have the CUSO needs to register with the NCUA in its CUSO registry. So you provide sort of a name, rank, and serial number kind of information to the NCUA, along with some financial data that they ask, as well as how many credit union clients you may have and credit union owners that the CUSO has. It is important to note here at the bottom of the slide that the NCUA is not directly regulating CUSOs. The NCUA has indirect authority through its credit union examination authority or its credit union regulatory authority. So the only action that the NCUA can really take with regard to a CUSO is if they don't like something when they go in and look at the books and records, they can inform the credit union that they need to either get the CUSO in line through any kind of relationship it has with the CUSO client or otherwise, or they will instruct that credit union to divest from the CUSO as an owner.
Brian, real quick, heading back to permissible services, we had a credit union ask if a CUSO could both originate and service business loans. Could the CUSO be the actual lender and the servicer of a business loan?
That's a great question. The answer is yes. And there are two things. There's loan support services as a category of permissible services, and that would include servicing, also would include sort of assistance with underwriting and processing of loans and the like. But then there's a separate permissible service category within the regs that allows for a CUSO to originate loans of all types that a credit union could make. So, and it's important to note, CUSO was instrumental in amending the CUSO regulations back at the end of 2021, wherein we advocated for a change to those regs to allow for loan origination, which means to originate, hold, and participate loans. Um, Prior to that, certain loan types were permitted, but not all. So now we were able to amend those regs to allow for all loan types to be originated, held, and participated and serviced by CUSOs. Great question. Any other questions?
Not right now, no.
All right, so I wanted to talk a little bit about what drives success in CUSOs and CUSO investments. So when we talk about success, I get this question a lot. You know, why do CUSOs fail? Why do CUSOs succeed? You know, what are the reasons for a good CUSO, a good CUSO investment versus another? And it's hard to say. Everything's case by case for sure, right? But one of the things that I worked through is that we want to think about what these three categories that are going to create a good foundation or roots for good CUSO investments. And so if we think about trust, what we're talking about there is if you're going into a collaboration, you need to think about who your partners are. You need to trust them. And I like to talk about this as not just, oh, the CEOs know each other from the country club, or the CEOs know each other from the latest, league meeting, or the like. They're really good friends. Instead, we want to talk about institutional trust. And so that means getting together not with just your C-suite teams or employees, but also thinking about how the boards understand the trust among the organizations as well, such that if a CEO were to retire or move on in some capacity, that doesn't sidetrack or throw a wrench into the CUSO or collaborative arrangement. So it's understanding and trusting your partners. It's really, really important. Um, Second, we have attention, and I think about this in two different ways. One, you want to think about your CUSO investments as part of or integrated into your credit union operations. So you want to think about this strategically. You want to think that your CUSOs should be part of your strategy as a credit union. If you're not investing in a shiny object for the sake of investing in a shiny object, you're not investing in something because you think it's a good opportunity for the credit union to get a gain on or just income. Instead, you're thinking about how this fits within the overall strategy of the credit union and thinking about how it is going to be integrated into credit union operations, such that if you were to invest or form a CUSO, all of your team at the credit union understand the importance of that CUSO, how it fits within the credit union operations, and the like. And the example I give here is I talked about property. I'll talk about property and casualty again because I mentioned it earlier. Let's just think about that. You form an insurance services CUSO or an insurance agency CUSO to provide property and casualty insurance. You need to make sure that your credit union culturally understands how that fits within your strategy, whether that's part of the strategy of being a trusted financial advisor to your members in all facets of their financial life, or whether that's part of, or in addition, that's part of your strategy in being part and owning the relationship that your credit unions have with their insurance providers, because it's part and parcel to your lending operations as well. And the reason you want to culturally drive attention to that is because you want to make sure that when a member comes in to talk to your member service rep or someone at the branch, and they ask about insurance, you want to make sure that member service rep understands that your property and casualty insurance company is part of your strategy as a credit union, such that they don't say, oh, you should go talk to my sister. She does this down the street, unaffiliated with the credit union, but just offering what they think is a great connection for the member. And it's because you haven't put enough attention into how that CUSO is integrated into the credit union strategy. The other part of attention that's really important is making sure that you have someone whose job it is to run a CUSO if you form a CUSO on your own. Oftentimes, I will get calls from credit union employees that will say, my CEO just went to a really good CUSO conference. I can't say that anymore. The conference is fantastic, but they'll come back from that conference and say, we need to form a CUSO. And they'll call me and I'll say, okay, well, what does the CUSO want to do? Well, we thought maybe this. And I say, okay, well, that sounds good. Let's start doing that. Who's going to run it? Well, I am. And I was like, all right, well, what's your job? Well, I'm the CFO. And I'm like, okay, well, you have a CFO job, right? You have something you need to do on a day-to-day basis. Running the CUSO is going to be a back burner for you almost invariably. And so you want to make sure in that sort of silly example, but in that example, you want to make sure that you have someone who's going to have the CUSO on the front burner. It's going to be important for them to pay attention to how the CUSO is proceeding, following the measures and the metrics to make sure that the CUSO is performing well and serving your members appropriately and the like. And if you have that person that is focused on the CUSO, then you are more likely to have that CUSO succeed. And I will tell you, sometimes I will help a credit union form a CUSO like I just described. We want to form a CUSO, we're thinking about this. And then I will end up in invariably helping that credit union dissolve that CUSO 2 years down the road because it never really took off. We never really stayed focused on it. And so you want to really have that attention to make sure that that CUSO succeeds, and all your CUSOs really, not just one particular CUSO. And then finally here, vision. So we've often had this as an issue. We want to make sure that, again, I talked about strategy a moment ago with regard to integration into your credit union's operations. But you want to make sure also that you have the same, when you invest in a CUSO or form a CUSO or form a collaboration, you want to make sure that you have the same goals and everyone involved has the same goals to make sure that you are rowing in the same direction, if you will, because we will often see CUSOs have trouble when they are not, when they have a difference of opinion, or for that matter, going back to the trust or conversation, if you have a CEO change and the CEO doesn't see the vision, or there's not an industry or a culture within the credit union to see that vision, then they start to have a difference of opinion. And an example here would be growth versus utility. So, sometimes we will have credit unions that invest in a collaboration because they want to grow that company and make money off of the revenue generated from that company. Other times we have credit unions collaborate and invest in CUSOs because they're looking for the utility of what that CUSO provides. So reading between the lines there, that means they're looking for the utility or the reduced expenses of getting the product or service from that company. So you can see those two things can be diametrically opposed. If you're trying to generate utility, you're not trying to necessarily generate yield and return in a growth model. And so that's a difference of vision. And so you want to make sure that you have the right vision. Everybody's at the table with the same vision. And I saw this as a concrete example with a business lending CUSO. It was formed about 15 years ago, going well for about 4 or 5 years, doing what everyone set out for it to do, and it was performing a utility. It was being that collaborative model, expertise, and reduced expenses, and they were getting and those credit unions were having the ability to put the interest income from those commercial loans on their books, and it was working just great. 5 years or so into it, CEO change at one of the credit unions. They're not as focused on getting the business lending or the business loans on their books. They're thinking about doing that in-house, maybe on their own to an extent, but they have this ownership in the CUSO and they're on the board of the CUSO and they're complaining that the CUSO isn't generating any revenue for their credit union. And that's a difference of opinion. And in the end, the other credit unions, by the way, were still focused on that utility function. And so in the end, the CUSO ended up blowing up because they had a difference of opinion, difference of vision at that point in the game. The other thing I will say on the vision And going back to my example where the CFO calls and says, I want to form a CUSO. We have some ideas. Here's one we're thinking of. You really want to think about developing a robust business plan for the CUSO, which sets out what the market focus is, market strategy, what the vision is of the company, and so on, so that you are focused on and you have a vision as to where that company should be going over the next 2 to 3 years. A lot of times we'll have credit unions that will have a great idea. They form a CUSO, they don't have that robust business model, and they sort of don't have the process and procedures in place to help with the growth of that company or success of that company. And without that, it starts to just sort of flounder. And while it may have been a great idea, it just didn't have all of the pieces that allowed it to continue on. And so you really want to have that business plan, that business model in place that allows you to build the success that hopefully you're all wanting to do if you were forming a CUSO. And then finally, the other thing in vision that comes up is who is control of management, who is control of the company. Those things can be an issue if you're investing in a company and there's a dominant owner and they're going to just dominate everything. Maybe that's not what you want. Maybe you don't have the same vision as to where the company is going. So you want to think about how your credit union fits into the management and control of the company. I'll pause there. Any questions? I do, again, have a slide here that has a lot of what I just talked about, but I like to keep the picture up. All right, these are some of the things I just put together, some of the misconceptions that we hear often here to just kind of walk through these. One of the things that we often hear is, well, our credit union directors need to be in control of the CUSO. So they need to be a majority position or maybe the entire board of your CUSO. And that is in fact not the case. Credit union boards, actually, the NCUA has a position that a credit union director should not have a majority position on the board. So of a CUSO, for example, if you have a 5-member board, the credit union director should not be more than 2 members on that board, not 3 or 4 or even 5. And the reason for that is because that CUSO then ends up being like a division of the credit union, and that could be an issue from a corporate veil piercing perspective. But we also like to think about this in a different way. We like to suggest that a CUSO's board, so the entity that is going to be handling the day-to-day management or day-to-day operations of a CUSO should be operational in nature. So the CUSO's board, let's use an example of let's say mortgage lending in this instance. Let's say you have a mortgage lending CUSO, and your credit union directors are saying to you, no, I should absolutely we should be on the board, we should be controlling this company, so on and so forth. The example I like to give in this instance is, well, the mortgage CUSO is really operational. It's handling, for example, underwriting, processing, assistance with origination, and maybe even servicing of mortgage loans. If the credit union were doing that in-house on its own, so through a mortgage department, would you have your credit union directors go and sit in that office or sit in those meetings with the mortgage department and be directing and or deciding how the mortgage department should operate? The answer is no. Your directors aren't meant to go and sit in a department's office and direct them on how that department should run. And so you should think about your operational CUSOs in exactly the same way. You should not have your credit union directors sitting on that board directing how your mortgage CUSO is operating, just like they wouldn't sit in the office of your mortgage department. The board. So what does the board do? The board does control who sits on. What does the credit union board do in these contexts? So they're going to decide how much to invest in a company. They're going to decide whether to invest in a company, how much to loan to a company if the company needs a loan. They're going to decide who they appoint to sit on the CUSO board. So they do have this decision-making authority with regard to the CUSO from an oversight perspective. But and they're going to make decisions that would be typical of an owner of a company, like whether they should bring on new members and new owners into the company, and the like. But they are not part of the day-to-day operations of the company. So again, that's one misconception that we deal with quite often. The second misconception is, is it important for the CUSO to distribute all the cash or the revenue that it generates back to the credit union? So in this instance, let's think of it as like a CUSO that is wholly owned by one credit union. Although you could have a scenario where it's a CUSO owned by 2 or 3 credit unions as well, or more. And the question is, if that CUSO is generating income, let's say it's a property and casualty insurance agency, because I used that example earlier. If it's generating revenue, does the CUSO really need to distribute all that cash back to the credit union? And the answer is no. For one, that CUSO may need that revenue that's being generated, that net revenue that's being generated, to reinvest in the company in order to provide better service, maybe do capital investments in software or something of the sort for that company. It also wants capital on its books to meet its any of its potential liabilities that it may have, and maybe even build a little bit of a cushion for operating expenses and the like. But the other thing to note here is that under GAAP accounting, and for that matter, the CUSOs that we form are typically limited liability companies, and so they're taxed as partnerships, and they're thought of as so the income from a CUSO is actually being recognized by the credit union on its balance sheet under GAAP accounting if it's wholly owned, or even if it's not wholly owned through the partnership accounting. It is actually recognizing that income as income on the balance sheet. So your credit union is not always cash strapped per se. It's really more liquidity that it's interested in. And so you are actually able to account for the capital on your books, even if the cash remains down in the CUSO's balance sheet. That said, if the credit union were and it's a wholly owned CUSO, if the credit union were to need the capital, it certainly could, as the owner of the company, request that some of the capital be distributed back to the credit union if that were something the credit union wanted or a need the credit union had in another capacity. So it is certainly always an option. But our suggestion is that you don't distribute that capital back to the credit union unless it's an absolute need, because if the credit union were to then need to invest more money into the CUSO down the road for whatever reason, that cash actually counts against your capital investments in CUSOs and your limitations. Is it important for the credit union to be as separate as possible from the CUSO? So we've talked about corporate separateness a little bit. I'll go through that a little bit for you right now. As I said before, a credit union needs to ensure that its liability is limited to its investment in the CUSO. That's a regulatory requirement. A limited liability entity, whether that be a C Corp or an LLC or a limited partnership, will provide that limited liability if you maintain the corporate veil. So you need to make sure that that entity has a separate board minutes, separate accounts, no commingling of funds, and you are adequately capitalized to meet your liabilities. Those are the kinds of things you need to think about in order to maintain the corporate the limited liability, the corporate veil. So those things are absolutely important and integral to limiting the credit union's liability for an investment in a CUSO. But if you recall, when I was talking about sort of what drives success for CUSOs, we talked about this integration and part of being a CUSO being part of the credit union's operations. You absolutely don't want to have your CUSO be so separate from the credit union that it feels like a complete third party and it's not relevant to the credit union's overall strategy. And there's not a requirement that it be completely separate, from a practical perspective. So oftentimes credit union employees will provide services to CUSOs through an agreement. So you keep that separateness as long as you have an agreement for those services. So for instance, IT or accounting services, a credit union could provide those services to a CUSO such that it doesn't have to spin up its own accounting department just because it's a separate entity. But you have to have an agreement in place wherein the CUSO is paying for those services or reimbursing for those services. But on the flip side of that, you want to make sure that you're maintaining a separate identity for the public within the public, right? So if you have a property and casualty insurance, you could have XYZ credit union have XYZ insurance services, and that's okay. You probably just want to have something that says XYZ insurance services, a wholly owned subsidiary of XYZ credit union. You can maintain that visual of understanding that it is not the credit union, it's the CUSO or the insurance services company that's providing those services. Um, but you also want to make sure, going back to what drives success, that your credit union understands that this company, while a third party, while a separate entity, is part of the credit union from an operational perspective, and that we are aligned in order to make sure that the credit union's success and the CUSO's success are driving together in the same direction. So that is essentially what I had for our sort of CUSO 101. I'm happy to answer any questions that you have or anything that comes up.
Any additional questions for Brian? And you can feel free to unmute your mic at this time as well. All right. I think we're good. Well, thank you all very much for joining us this morning, and thanks again, Brian, and thanks again to Randy and Nicuso for your support in putting together this series. Um, if you haven't already, make sure you register for part two. We have that coming up on May 26th. Part two will be exploring partnering with CUSOs, and we'll be covering, whether how do you evaluate the CUSO, whether you buy or start one, or do you partner with one, what you should be looking for, how would you structure such a partnership, how will you measure success, and then we'll also cover common pitfalls and so that you can look for certain things to avoid. But again, thank you all for joining us. We'll make sure you get the recording and slides. If you have any further questions or follow-up, please reach out. You can reach out directly to Nicusa. I think Randy put his email in the chat, and they're happy to answer any further questions. Or of course, you can reach out to me if you're from Connecticut. So thank you all, and we'll see you soon.